So thank you, everyone, for coming. I want to take a minute to thank the ESE, Rob, and David for getting this conference together. It's a tremendous turnout. I was listening to some of the statistics. It's really, really amazing. And then Rob asked me to come and talk about lessons from investing in Latin American searches and help moderate the panel in the morning. And I never imagined when he asked me that it was going to be the first session in the morning, so I think there's a couple of, there's one big peril of doing this in the morning, right? Most of you must be working out your gin and tonic still. But, on the other hand, I guess there's no bar has been set. So let's see how well we do and hope we don't disappoint. But before we start, I really want to give a perspective of why I think we're talking about search funds in Latin America. And these are two graphs from the latest search fund study made by the school here. And I think, the first interesting observation is the growth that international search funds are having, right? And then if you look at the composition of that international growth, you just look how Latin America is going about it. So, I still think that there's a lot of history to be reading about it, but there's a lot of indications of how popular this thing could become in the longer term in the region. And I think it's a very peculiar region as well. So hopefully we'll be able to provide all of you with a little bit of insights into why this is happening. Okay. Before we go on, and they told me not to do this, but I really want us to be able to help. I want to know who is in the audience. Okay. So, couple of questions, quick show of hands. I don't want to spend more than a minute on this. Who in the audience are students, prospective searchers, or searchers right now? Good. CEOs. Investors with no search fund experience. 1 or 2 search funds. And let's call them the serial investors. Perfect. I had another one for Will Thorndike, which is addicted to investing. Anybody else? No. Okay. Good. In terms of the rules of the panel, guys, I want to make this a conversation more than anything else. I have some pointed questions about, not pointed, but very general questions, and hopefully we'll go through them. It's my liking that if anybody has a question, we should get it in, but not at the expense of interrupting the panelists, which I think can add a lot of value. So the more we make this a conversation, the better. And let's go for that. But now let's go into the good stuff. Okay, let me introduce you the panelists. I truly believe we have what I call, a panel of search fund rock stars here with us today. What I think is really interesting, and the beauty of it is we have a mix of sophisticated investors that are involved in the region with local entrepreneurs that are also investing in the region. And I think that will be a great mix. I think most of you know who these people are, but I will let them introduce themselves. And Gerard, why don't we start with you?
Okay. So my name is Gerald Risk. I've been involved in the search fund community for almost 20 years now, first through an operating role at Asurion as CFO, president, and now vice chairman. And then over the last decade as an active investor. All over the world, mostly US and Canada, but increasingly Latin America. And in fact, because our largest 2 investments are Alpha Credit and QMC, I think about 25% of the capital we've deployed is in Latin America. So excited to talk about the topic. Thanks, Jose.
So I'm Mario Sicilia. And we, together with my partner, with Jose Antonio, we raised a search fund in 2009, bought a company in 2011, and then operated for 4 years and sold it to a family office in Mexico. And ever since we started investing in search funds, and I'm also excited to talk and hopefully we'll be able to contribute something that is of value to you.
Jose.
Yeah. So my name is Jose Luis Orozco. I'm co-founder and co-CEO of Alpha Credit. It's a consumer finance company in Mexico. I'm not an investor, so I'm different to these guys. So don't come for money with me. But I do have experience in raising a lot of capital from a different pool of investors, and we've raised 4 different rounds of equity across over the past 8 years in Alpha Credit. So hopefully I'll be able to contribute something to the conversation.
Great, great. So I think if we, I have 3 main topics I want to go through, and let's take it from the high level first, right? I mean, why do we think Latin America is a good market for search funds? Mario.
Wow.
Let's start with the weakest guy first. So I think there's a combination of things. I think what you're trying to find is arbitrage opportunities, and I think Latin America makes a good market for arbitrage opportunities because several reasons, but some of them is that many industries have not been sophisticatedly addressed like they have been in other markets like the US. And I think a very good example of that is that you guys started companies in industries that you liked, but there was not a good target to buy, and that tells you something about the markets in Latin America. So you can actually find opportunities by looking at what's happened in the US specifically. I also think that entrepreneurs have a hard impact in the companies that they acquire because they have more talent, and not more talent, but compared to what's available in the market, they are more of an outlier in terms that they are more sophisticated than the rest, and also they have better networks, because in our countries, connections are very important, and you get people who are very well connected in their local markets, and they are sophisticated as well, so that allows them to just contribute more to the companies. And I think it's also interesting that you can find unsophisticated sellers, and that also generates opportunities for larger arbitrages. And specifically in Mexico, if you address these markets where you can find a company that's being sold at a reasonable price, you do have a developed private equity market that for an exit makes it attractive as well. No? I think those are some of the more important things that we see.
And that's interesting because I think it kind of addresses both searcher and investor. The same coin addresses the opportunity for both of the most important stakeholders in the formula. So good.
Just building on what Mario said, one of the things that I like about Latin America is the confluence of this lack of sophistication or lack of available capital with the size of the markets. And it means that through a search fund vehicle, you can buy businesses that you'd never be able to buy in the United States. So, it's impossible to start in a super capital efficient way, start a consumer finance business, or buy a financial terminals business, or buy an ice manufacturing business, or buy a cold storage business. These are all, in different ways, businesses that have been bought through a search fund model in Mexico as an example, but have sort of played out in the United States already. So I love the quality of businesses. This seems like a trivial point, but it's important, which is at least for U.S.-based investors, the fact that Latin America is in roughly the same time zone,
Yes.
actually has an impact, because as an investor, you want to have a relationship. There's no point in really doing it if you don't have a relationship with the search fund entrepreneur, and it's just fundamentally easier relative to other regions of the world,
I agree.
to build a relationship with an entrepreneur in Latin America from the U.S. And it sounds trivial, but is an important point. And, I mean, it's Latin America, so the entrepreneurs are just more fun.
No offense to the local.
No offense to anyone else, but, I mean, who's kidding who? I mean,
Yeah.
how many Mexicans were at Boca Chica last night at 3 in the morning?
Great. Anything
No,
you
no,
think
so
you can add?
I completely agree. So, and I think, by the way, this applies to all developed markets, not only to Latin America, because, maybe some people here from the forum are not from Latin America, but they are thinking about starting a search fund or doing a search fund outside developed markets. And I think all these lessons apply to everywhere in the world, not only to Latin America. So, for example, if you see the basic industries in Latin America, they have a huge potential. So going back to what Gerald was saying, if you do healthcare, education, financial services, so very basic industries that are completely attended in developed markets, you can find huge opportunities in developing markets such as Latin America. And I think that just goes around by saying, if you have the right talent pool, which the search fund model has, the right talent pool, the right group of investors, access to international markets with international investors, you can find great opportunities in countries like Mexico, Brazil, Latin America, or any other developed market. So I would just agree that there are huge opportunities outside developed markets, and it's a great opportunity.
Perfect. I think it's great advice about, doesn't matter where you do a search fund, I mean, that investor, searcher / CEO relationship is just probably the most important relationship that will happen, both as a mentoring and as a growth tool. It's very important. So I tend to agree with that. So let's move a little bit deeper, and I think the other question I might want to explore, and this one has, I believe, many layers that we can go into, is, and if I want to be a search funder in Latin America, what are the biggest challenges I will face? And if I am an investor, what are those risks? And I think we can also compare risk of other markets to Latin America also. So what are those challenges that are unique to the region that we all, I have lived that. So, but Jose, you want to start?
Yeah, sure. So one of the main risks of doing this in, again, developed markets, but this applies of course to Latin America, is access to debt. So talking to as a CEO and as a search funder, previous search funder, there's almost zero access to debt in Latin America and in developed markets. And what that means, or what that implies, is that when you're searching for a company, you cannot find debt to lever up the acquisition. And that has an additional constraint, which is now you do have to find that, so to maximize returns for investors. So it puts you in a position where you end up negotiating with the seller, a seller financing, and so it's just a harder negotiation that if you're in a developed market you won't have, because you have the bank behind you to put leverage on top of the equity. So I think that makes it harder to do an acquisition in Latin America and in these countries. Just access to debt is very, very scarce.
And I think it's not only, it even varies by country. It's difficult in the region, right. and within the region, there are different levels of difficulty of getting debt.
Exactly. Yeah.
I actually think it's for burgeoning fundraisers out there, I think it's an opportunity. I hope in the next 2-3 years somebody does a credit fund focused on search funds in Latin America.
I agree.
Yeah.
I agree.
That's a message for Pacific Lake? Or?
Somebody.
Maybe.
Not me, somebody. Let's hope somebody does it.
Some debt fund, definitely. Yeah. Mario, you want to add anything?
No, I mean, just in terms of that, I think seller financing is a pretty good solution. The way that we did it when we structured the seller financing is that we also use it as an escrow, and that really helped the returns, because it was not only that we were financing the acquisition with the seller, but we were also not putting the money for the escrow, so that really helped the returns of the investors. So if we would find any hidden liability, then we would go against the balance of the loan with the seller. And for the seller, it makes a lot of sense, because they're gonna put money in the bank, so you just give them a better rate, and you give them the shares of a company that they already know as a guarantee. And in our case, it also helped us to have a seller who was aligned with our success, even though it was only for the debt return, but he was aligned. So he joined our board. You were in the
Yes,
board with us. And he was very helpful. I mean, he really had an influence in the success that we had with the business, because he knew the business better than no one else, no? But I think there are many other challenges that you face. One of them, which is it was very difficult for us to deal with, is the lack of information and reliable information. Some of the sellers do not even know how much money their company is actually making, because they structure financials for tax purposes. There are no databases that are reliable. So that makes it hard. You have to have a lot more interactions with the seller before you can actually understand how much you're selling and how much you're making. Many times they don't even know. And then you have to go through a quality of earnings process with an auditor in order to reconstruct the EBITDA or whatever number you're looking at, because people are putting expenses into the business that are not related to the business, drivers, whatever, and you have to redo the numbers, and that takes time. It takes money as well, because you have to pay the accountants to do that. And there's also, I mean, it takes longer, and the probability of finding something that is not what you expected is a lot higher.
And the shock factor to the owner. I remember the deal you ended up buying was one of the first deal you looked at.
Yeah.
That you, Jose Antonio, looked at, and it fell through on your due diligence. And it was, and I imagine that there was a digestion period to the owner that, I don't know, 8 months later or something like that, you guys came back and you were able to close.
A year later, yeah.
Yeah.
We got lucky because the business that we bought had a partner in Italy, so they reported to the partner in Italy, so their numbers and everything were, I mean,
We're fairly good.
were
Yeah.
fairly good. They only had one line, which was very clear that was not part of the business, but everything else, it was very well done. But yeah, I think the lack of information, it makes for, first, valuation is difficult because you don't know the numbers. And then there's also this part of contingencies, no? Because there's tax and labor contingencies that you can find very late in the process, or you might never find, which is worse. But those are knockout factors that if you find one of those, it's impossible for you to do a transaction. You might like the business, have the right price, have the right seller, but then you find a labor liability, and you cannot do it because they were paying people on the side, and now you have to reintegrate that. It also impacts valuation because people have tax-efficient structures, and they look at the numbers as cash flow. And when you pay taxes, the cash flow gets reduced because now the IRS is your partner. And I think you even had a name for that, no?
Yeah, I call it the Ginnie Mae valuation process, which is, when you don't pay, when these companies don't pay taxes, your EBITDA is your net income. So a 6-time multiple of EBITDA in a tax-paying country becomes a 9 or a 10 times net income.
Yeah.
This country is a 6 EBITDA becomes a 6 net income, right? So so then it becomes, and there's no risk when you own a company forever, right? So it's kind of like sellers used to tell me, no, the money I want from you, I want to put in the bank, and I want to make the same money I make here, So it's like a free bond valuation. I mean, it's really difficult to get the deals done. And how you deal with this risk, because I mean, also I know in Brazil, for example, structuring around labor law issues is really difficult. So do you find that, and maybe Gerald, you can help us here. Do you find that the legal structures that have to be done are as a U.S.-based investor, do they take a while to get comfortable with, and how you mitigate the risk inherent in the deals?
I view the legal structure stuff as a problem that gets taken care of. I mean, there's sort of at least at the transaction level, there's a kind of an emerging practice for Mexico and for Colombia and for Brazil. So I feel like those are solvable problems, but you need to be attentive to them.
On top of them.
Yeah.
Yeah.
I think another risk, another challenge faced by searchers in Latin America is because the markets are smaller than, say, the United States, there's at least a perceived challenge that there are fewer targets. And I think generally that's true. At the same time, it's a little offset by the fact that you can look in industries you probably can't look at in the United States or a more developed market. But it does mean that searchers need to be prepared to cycle through industries more quickly. You might look at one industry, and in a more developed market, there might be 100 targets. In Colombia, there's 10. And so you just need to have a higher velocity of cycling through industries.
Yeah, no, and that brings me to one of my business partners' pet peeve in the region, which is buy versus build. And I don't know, maybe Jose, you can help us, because how does the panel feels about startups versus more traditional search fund, go and buy a company, right? And we've seen a number of those. They're not super prevalent, but I have an opinion on that, but I'd love to hear you guys first.
Yeah, sure. So our brief story for those of you guys that don't know us, we spent 18 months searching. We put 6 LOIs. Out of the 6 LOIs, half of those deals fell through because of what Mario was explaining. So fiscal contingencies, labor contingencies, or very aggressive fiscal exit strategies from the owners that made the deal unviable. But during those 18 months, we saw many companies. But out of those companies, we were a lot focused on financial services. So after 18 months, Augusto, my partner, who's sitting right here, and we decided to go back to investors and say, hey, what about if we spend 50% of our time working in a business plan to start a company from scratch with all what we've learned about the financial services industry that we've been searching for 18 months now. And the other 50% of the time, we'll try to close one of these deals that we have on the pipeline. And we found out that investors are, in general, very open to doing that. Once, I think, 2 things happen. One is that you demonstrate to investors that you've done your research, you've done your due diligence, and that you know the industry where you want to start a company. And 2, that you actually know the industry, you do the research, and you do a very in-depth analysis for a long period of time of the industry where you want to start a company. So I wouldn't say that the search fund model it's made for a startup. I don't think so. I honestly don't think so. But I do believe that it's an alternative to in our countries in Latin America, especially in Latin America, it's a good alternative to start a company in an industry that you feel comfortable, that you've done your homework, and that you couldn't find the right target to acquire. So I think it's always something that you have to have on the back of your mind to see, if there are no good targets, but I truly believe in an industry, and I truly believe I know the industry, to start a company from scratch. And I guess investors are pretty open to doing this. Mm-hmm. It has happened only a few times. You counted on those few times, I think 10 times we were
I think that's
mentioning
the
yesterday.
number that I heard, yes.
So 10 times out of the whole search fund spectrum. But I think investors have very good returns in general with startups, so very good experiences with startups.
You see, no. Yeah,
I
you know,
agree.
it's interesting because I think the startup thing, in my mind, comes hand in hand with what Jared was mentioning about. Jared mentioned something that I call that in some of these countries have breadth of industry but no depth. And what happens is when you find a good industry that you just don't have viable candidates, you know, looking at the startup option might be your best way, your best option on the table. And I promote this quite a bit, and I was talking to Augusto yesterday, and it's very interesting, just like Jose mentioned. It's, you know, it's a promoter, but it's not about go out and do a search, raise a search fund to do a startup. No, you raise a search fund to buy a company. Experience will lead you to, you know, realization moment. I'm going to do a startup. And I personally think that what happens in these developing countries, it's not about developing technology, it's not about competing with Google, it's about taking proven business models that are out there in more developed economies and saying, wow, that model I can take to my country and I can implement best business practices and I can change the competitive dynamics of the industry. And I personally done that twice, and I know some other people have, and you know, so that's kind of what we're talking about here. It's not about making the next Google on it.
I mean, just to that point, I think the entrepreneur who's raising a search fund is not always, cannot always naturally shift to being a startup person. I think it takes some reflection in order to decide if you want to pursue a path where you're going to start a company from scratch, because it does take, it's a different challenge, and it is not always that the profile of the searcher
I agree.
fits well with a startup. And I think the searcher should really reflect on whether they want to pursue that path, because it's a different path, no? And it can be a lot more successful, but it's just different.
And I think maturity, the markets also drive this, right? As I started investing in Mexico and I started investing in Brazil, my biggest concern at the beginning was there's no developed middle market M&A. It's like that M&A middle market is not really developed. So part of the issues you're mentioning, will my seller have the right price expectations? You know, and can I actually have a rational price negotiation with them? And in markets I have participated, that was not the case, and that's what forced me to do the startup. So, yeah, it's not for everybody, it's very market dependent. So I think Brazil now has proven that there's a healthy, you know, middle market that wants to sell the company. So I don't expect to see that many startups in Brazil as I thought at the beginning, but I think any searcher here going to a new country, you have to think about this. You know, how is that developed? And because like we used to say, my partner and I, you know, it's like Cortez, right? We burn the chips and we're going to get it done, and we're going to get it done right. You know, so I mean, I think for me that's the spirit. But, you know, but talking about Latin America and what are the risks to investors, I think our region is well known for boom and bust economic cycles. And not the most stable of currencies.
Yeah.
So how you guys look at that? And there are many subjects there that I think are quite interesting that affect both the searcher and the investor.
So talking about the perceived boom and bust and the currency risk, I think for an investor, the way I think about it as an investor is it just forces you to double down on your commitment to long-term investing, and you just have to be prepared to, maybe it's a 5-year outcome, maybe it's a 10-year outcome, maybe it's a 15-year outcome. You just need to be committed to a long-term hold, which personally is how I invest, and I generally approach the investing from a bottoms up. Just, is this in an absolute sense a great bottoms-up business, great value proposition to customers, the right financial metrics, and rely on a long-term view to sort of say, hey, the economic cycles, the currency fluctuations, those will sort themselves out over time. But I'm buying a business at a great price with a great partner, and in the long run, that's going to work out.
But I think currency, I mean, it plays an important role in at least two parts of the search fund process. The first one is the negotiation between the entrepreneur and the investors, right? Because there's a currency risk, and who's going to bear that risk, and how is that going to get sorted out? And I think to that point, there's an additional piece of negotiation that search funds being raised in countries like ours has that they do not have in the US, for example, no? Because currency is not an issue. And it's just an interesting question, and I think the industry has not yet sort of standardized that part on how do you deal with the currency risk and who's bearing that risk when it comes to entrepreneurs and investors. So that's the first part, and then the other part is, as Gerald was mentioning, like how do you time the exit and what impact that exit, the currency is going to have in order for you to make a good return in that investment. And I think those two also go together because you're sort of setting the incentives in regards to currency risk and how do you want to align those for the entrepreneur to sort of do.
Could you go a little bit, I mean, I have two different comments, but on the currency risk and bearing the risk, where's that pendulum right now? How is it swinging? And
So you told me. I think from my perspective, and this is very biased obviously, but from my perspective, there is not much that the entrepreneur can do in regards to currency risk. So what you would like is for, at least me personally, for investors to bear a bigger part of that risk, because entrepreneurs cannot do much with currency or macro, and you want them focused on the business and not so much on the currency. They could take bad decisions if they give in to currency swings, and also they cannot hedge that risk better than what the investor could, because the investor has a portfolio of investments and the entrepreneur has one investment, right? So there's no way to hedge that risk. It's more effective for the investor to hedge it. And also within the same group of investors, people might have different view on currencies. So there's no reason for the entrepreneur to hedge everyone the same way if everyone might have a different perspective, no? So from my point of view, it should be more on the investor side, but I also see how investors think, I mean, spend dollars and they want dollars back, no?
I'm biased as well, but I do believe that investors should bear most of the FX risk. So there are two risks of the entrepreneur, and by the way, we are, as entrepreneurs, we're bearing our FX risk ourselves. But but there are two risks about bearing the FX risk as a manager. One is that if you have a huge devaluation, then your returns get crushed. So there's the incentive that if the company is not growing that much to compensate the devaluation effect, then the entrepreneur has a huge incentive of just giving you the keys to the business and as an investor and saying thank you, my returns are all down and I'm not going to make any money out of this investment. So I think that's a huge risk for both investors and management. And then there's another perception in our countries, which is when you have a downturn in our countries, which you will have, I think those are the best times to double down on the investment. And you need to have very sophisticated investors behind you that understand it, that understand that in a downturn, you have to raise more money and actually go out and try to do acquisitions and double down on the investment. If you don't have investors that know how these countries work, they typically get afraid because they say, well, my IRRs just got crushed and I'm not going to double down on this investment.
it looks bad on paper, right?
It looks very bad on paper.
Okay.
So you do need to have those more sophisticated investors that understand the countries. And then, and understand the risks of the FX and understand what Mario was saying. I completely agree with what Mario was saying. As an investor, you can diversify. As an entrepreneur, you can't diversify. So the macro risk, I mean. So,
Jose, what I see is, 10 years ago, when Mario and
Jose.
Alpha Credit were raising money, the standard was, you raise money in US dollars.
Yeah.
And the pendulum is, swinging
It's
much more to what you guys are saying, which is the currency risk being borne mostly by investors. I think there's some creative, there's a bunch of creative solutions out there to how that happens. So I think, I think over the next year or two, you'll see some convergence around some good answers that get what really you want between investors and entrepreneurs, which is like the primacy of alignment, that where in most cases, the entrepreneur is making decisions in their self-interest that benefit investors, because that's kind of the whole, that's really the foundation of the search fund model, is amazing alignment and incentives between entrepreneurs and investors.
I agree.
And I think we'll see that kind of emerge around this currency issue.
Yep. I guess I think one of the beautiful things about this community is that both parties are interested in making it succeed.
Yeah.
So I agree with you that experience will teach what the right answer is, and we will get there. I think some people in this panel, this is the price to pay for being a pioneer, guys.
That's right.
And I think it also has to do with the business that you're buying, because not all businesses have the same cash flow profile.
Yes.
And if you can return the money, then you can structure something very different. I think that the structure where you have a redeemable equity and non-redeemable equity is much more important in our countries, because if you have a high preferred return, and that's probably currency linked, you want to return that money as fast as possible, because the entrepreneur is first in line if something goes wrong. So if you can actually redeem the equity, I think it makes a big difference. And I also think with the IRR, probably you can get a mix where you are bearing some of the risk by paying, probably having a higher curve, but then you get rid of the dollar component and you return pesos at a probably higher threshold, no? But I think it has to do with structure as well. There's not a one suit fits all, because some businesses are different, no? In your cases, for example, you don't want to return money. You want to invest more and more and more money. If it's a cash flow producing business, then you can structure something more
Very capital intensive.
more
Yeah.
interesting, no?
Yeah, so, I mean, a couple of comments. I want to comment final to one comment that you mentioned, but I think that what Gerald mentioned about the long-term holds, it rings true, and I want to be more specific, and if this is not what you meant, feel free to jump in. But the long-term hold in pure finance theory is about the PPP, right? It's about if there are currency fluctuations, if you hold that inflation, which catch up over a long time, and that helps. And another mantra that I talk a lot about, and when you select your investors, searchers, it's about the mentality that Gerard mentioned. You can never, in no market, you can time the exit, but in Latin America, even worse, right? Because you might be ready to exit, but the economy is down, and the currency is just not there, and you might have to wait longer. You might have to wait another 5 years just to get it done. And the whole idea, like you guys were mentioning, is to have the entrepreneur focus on operating metrics being really good, rather than dollar returns being really great, because they will come with the right patience, holding the basic economic absent any exogenous events on the local economies, which is a risk that you also bear. And then another thing that was mentioned, I think is truly interesting, is that the investors that come into Latin America, they need to have a different type of stomach. It is about doubling down when let me not say that expression. When things go really bad, okay? and I have plenty of examples in my board of directors of people who were in zero value of their companies, and investors came double down and took their companies public. So it is about having the right people like these guys here that know their countries, they know how to navigate it with investors that trust them and can do that type of affair when things go bad, because it's a very different.
I think there's an interesting point there where you say, like, in Latin America or other countries, you might need to hold companies for a longer period of times. You also need to have the right investors, because what happens is that you have this very high threshold, which is, let's say, 35% IRR, which might go to 37 in order to fix for the exchange rate. But then if you're gonna hold it for a very long period of time, at some point you need to have a conversation in which carry becomes equity, because otherwise the business will probably, if it's a long period of time, unless you're Alpha Credit or QMC or Asurion, you're not gonna return 37% IRR. So you need to have a conversation with investors and say, okay, this is a very good business, it's gonna generate that 20% IRR. It's a very good investment, but if we're gonna hold it for a longer period of time, then we need to adjust the terms in order for me to go pari paso with you, because otherwise the entrepreneur loses by having a very long period of time, because IRR is very difficult to achieve, especially if you keep on growing. It becomes more and more difficult to reach a threshold, no? So if you do not have the right investors, it makes for that conversation very difficult, again.
Yeah, there are many situations that the board has to step in and look at the situation rather than the contract. And there's a good footnote on, Rob sent me this compensation study, there's a good footnote there that I really loved. He said, before you read it, even read the footnote, and it was, it's about that. It's about this trust that has to be built between entrepreneur and board, and they both have to watch out for the best interest of all stakeholders. And that's really interesting. But, on this subject matter, how important do you guys believe is investor selection in a Latin search? And how would you advise investors to think about fellow investor mix and board mix as they consider investments on a company? Jose, you want to start?
Sure.
Yeah.
So we get asked this question a lot by our search funders, and there are, I think, in my opinion, you need both international investors and domestic investors, and the right mix, can vary, but we could have never achieved what we've done with Alpha Credit if we only have domestic investors, so local investors, and probably wouldn't have achieved the same thing with only international investors either. But in our case, US-based investors, so we have 85% of our investor base is US-based, 15% of our investor base is Mexico-based. That 85% started at 70%, and it became 85% because we've done 4 rounds of equity. But we've raised so much money over the past 8 years that wouldn't have been possible to do with only domestic investors. So I guess it depends on the strategy of the company that you acquire, or in our case that we start, the type of investors that you need. But I would say investors in the US have access to deeper pockets, not only because the investors have deeper pockets, but also because they have access to a huge market. So in our case, we've raised a lot of debt on top of the equity. And that debt has come mostly from the US. And it's part of the same reason of having US-based equity investors that have attracted US debt investors to invest in a Mexican company. So it's, again, we are a capital-intensive business. Money is our inventory. So we needed to have US-based investors in order to attract US debt investors as well. And then, so that's on the money side, but I would say there's a bigger impact to having more sophisticated investors and international investors that have different perspective. Because going back again, we're in a very basic industry, financial services industry, that if you have international investors or U.S. investors that have seen how the story played out for a financial services company, they can add a lot of value to the board and to the company in general. Not only money, but also sophistication and also network and just knowledge about the industry. So in my opinion, you do need the local investors that have a lot of local insights, perspectives. They have the relationships that Mario was saying when we started the conversation. But you also need the international investors that have a completely different perspective that will help you growing faster the company going forward, I think.
So it's interesting. So you think one of the biggest value added they bring to the table is access to capital?
It's access to capital and completely different experience that will enhance the knowledge of the management and of the company in general.
That's what I call bringing best business practices to
Exactly.
countries that are not used to having these best business practices implemented.
Yeah.
And in my personal experience, especially at the board directors level, that brings a competitive advantage to the company.
Absolutely.
If you form that board of directors correctly. And how would you guys differentiate between this investor composition and director composition? When you think, I'm a searcher now and thinking about, I got to have this board composition. How would you think about it?
Well, Jose, if a searcher came and asked this set of questions of me, those are conflated. How do you think about your investor group and your board? I think as you construct your investor group, you want to think very carefully about what are the implications for my board, because I think it's just a critical challenge across the search fund world. It potentially more acute in Latin America, but maybe not, of constructing boards, because with the explosion of search funds being raised, the number of people with traditional experience sitting on boards for search fund companies has just been, far outweighed by, and so it's a real challenge to construct a board. And so as I talk to searchers about, okay, how do you think about constructing a board? You got to think about it up front. Who's going to have the time? Who has the kind of experience that might really help me? And I think a critical element of a search fund board member is the fact they're working with a totally inexperienced CEO. And that's very different than being a board member of any other enterprise. It requires more patience. It requires probably more engagement. And so as you construct your investor group, you really want to have in the back of your mind, do I have a good shot at one or two people who are going to be really good at helping to mentor me become the leader I have the potential to be? And that could be a local, it could be international. Usually it sort of works out a little bit of both, but it's really critical to focus on that from the beginning. And then through the search, why do people sit on boards? Why does somebody like that want to be a board member? Usually it's because you've built a relationship with them. And so that's another thing that, hey, up front, focus on, do I have a suite of 3 or 4 people who might look like that? And then through your search, focus heavily on building a relationship with those people.
I agree. So you bring, as I hear you talk, there are two lines of thought that come to mind. One of them is institutionalized knowledge of search fund directors, right? I think the community thrives on some tacit knowledge that is what we've been talking about. At the end of the day, you have to trust your board, and I think as a director of a non-search fund company, I think that interaction with the CEO is very different and that's a tacit knowledge. So I think that's one of the challenges the community is facing. I think you were trying to address that, which is I mean, there are tons of good directors out there. I think what have made this very successful in many occasions is that tacit knowledge of how search funds work and what doesn't work in a search fund. Yesterday in one of our meetings, someone gave an advice to an entrepreneur that was, track records, first year operators that do acquisitions, their track record is not good. That's a statistic, and that's known because of involvement, right? And these tidbits of information are really important that I think the community, as it grows, as we see here, it is important we figure out how to disseminate this knowledge if the interest is to continue with the same type of community all around. But let me ask another question that I think goes hand in hand with what you say is all money created equally in the search fund community?
What do
No
you
one
think,
wants to
Mario?
take that one.
I mean, our deal was long ago, and we ended up not getting much money from the search fund community, to be honest.
Jim Ellis.
Jim Ellis gave me 100,000, which was basically not much. I mean, I'm partially joking, but honestly, like
Come on, you got more than.
when we tried
I
to
know
do
for
the
a fact you got more than
acquisition,
100K.
just for everyone to feel better of themselves, we were missing 67% of the money. So we needed $18.5 million, and we had six. So Jose went out and raised the rest with people that he knew. But we did not get much from the search fund community. But we had the benefit, given that was the case, is an experience of one, but we had a very good board. We only had one person, which was you, with a deep knowledge of the search fund world, and we felt that you pretty much did. You represented like the culture, the philosophy, and you helped us with all these statistics, knowledge from the past and everything. But other than that, we had directors who had relevant experience in the country and in the industry, and that really
very
made a
useful.
difference. So we had the seller in the board, we had a private equity guy who had bought, run, and grown businesses in Mexico. We had a logistics expert he was the director of one of the main logistics companies in Mexico. So I think once you have one person who has the knowledge of the search fund world, what has happened before, what works, what doesn't not work, you're pretty much free to choose all the others. And I think choosing the others with relevant experience in the industry makes a huge difference, no? But I definitely think that not all money is equal. And I think when you're raising money and when you're going to invest, you really have to spend time with investors, understanding how they think, how they feel about businesses, how much they've invested in the past, and also if there's chemistry, no? At the end, it's just like friendships. I mean, some people you get along with, others you don't, and it also has to do with just, do I feel like I want this person to be in my board or be an investor and have a long-term relationship with? And some people are better than others at connecting and stuff.
So your comments bring to mind two statements, and one of them is a personal opinion. I think, you were one of you two guys were actually one of the first search funders in Mexico, and I think you did something very interesting, which is you bought a larger than usual company, which is kind of becoming the norm in the region. And I think it's a good thing too, because you buy a more stable company with better systems and processes. And I think you were kind of but this is personal opinion, editorializing, you know it better than me, but I think you were kind of a victim of being one of the first ones that had to raise so much money. And I don't think the system was set up for that. I'm seeing now bigger checks being written, and people not going through the headaches that you went through. Well, and that's just as a piece of information. I think the other thing that you bring to the table, and I have bright memories, and somebody asked me yesterday about this also, is what about language barriers at the board of directors? You had a very good value-added director that has some issues communicating with the board because you had one member that was also value-added member, very important member of your board that couldn't speak Spanish.
And who owned 67% of the company. So he was relevant.
So we had to hold the meetings in English, right?
But I think, I mean, it is a barrier. And this guy was not able to contribute much in the board meetings because he could barely speak English. So what we did is that we sort of tried to talk to him offline, off board, and that's where we got the value added. But in the meetings, and this was, I mean, it was just a fact, he was not able to contribute as much because he was not comfortable, no? And so he would just go quiet and he would not participate. It is a barrier, I think.
It is definitely a barrier. So we've interviewed many potential independent board members. For us, as a financial company, it's important to have independent board members. And one of the things that we always are worried about is having a local expert, but that is not comfortable having board meetings in English. So it is a barrier, and you know, it reduces the spectrum of people that you can actually have in your board meetings, and it's just uncomfortable for them. You know,
Yeah. You know, my experience has been it's not only a language, but it's a cultural barrier.
Mhm.
So
Yeah.
as I search out to look for directors in the company, I usually not only search, it's not about the fluency in the language, I purposely look also for probably educated outside of the country, you know, because that also brings a cultural symmetry to the board that I know from my base.
Yeah.
I had a situation that I ended up with an American that was actually more Brazilian than American, but I ended up with him because I started looking for that Brazilian that was bicultural, right? That kind of knew how to add value.
I think the right way to think about your board is they work for you until they fire you, right? I mean, that's how it works. And if you have not been fired, they're working for you, and that's the way that you should address the board. And I think if you think about the board as being there to help you, it's very different than if you think about the board to being there to monitor you because they represent investors, no?
Yeah. I think the board is a make or break if you're going to be an outlier in value creation.
This is a
Definitely.
tactical point, but the other challenge of constructing a board in Latin America, if you have, like most search funds do, a mixture of international and local investors and board, is geography. So just the physical requirements of being together in person. And so another thing that I recommend to the searchers I work with is like lean into video technology. You know, don't make it a requirement that we're having 4 physical board meetings a year. Do 2 and do, you know, do more, but shorter and by video conference to, because it's a real barrier, and you can't
It's
just
taxing.
ignore it.
It's
Yeah.
taxing because not everybody can travel all the
Yeah,
time.
yeah.
Yeah,
So
definitely.
use, you know, there's a lot of great technology. Once you've built an in-person relationship, that the technology works.
Yeah.
You know, to just, for Mario and I to be on a video call is highly effective
And cheaper
and cheaper.
nowadays. Yeah. No, very good advice. And what about questions? I mean, you guys still working out those gin tonics, or or are there any questions out
So
there?
just one of the things I wanted to mention that I forgot is when you're trying to buy a business, and it might sound counterintuitive, but the first thing that you want is for the seller to have the right advisors, like to have a good lawyer and a good tax advisor. And
Very good
I mean,
point.
it just, I left it from the beginning, but it's just something that I think it's a very important lesson that we learn, because sometimes you think that because the guy does not have the right advisors, you can actually take advantage of, and it ends up being the other way around, no? You ended up finding that the tax structure is not gonna work because his advisor, it's a clown, and or that the contracts are really hard to negotiate because he has never done reps and warranties before.
Doesn't know what's fair and what's
Exactly.
not fair.
It's very difficult to negotiate with those advisors. So if you can, hopefully you can get the seller to have good advisors early on the process.
how you built that and how you dealt with the frustration of not being able to close deals in the speed that you probably were used in your previous professional experience and so on.
I guess that one's for me because no one else has bought a business here. So,
Gerald.
Gerald has bought.
Building relationship with sellers? Yeah, no, you guys go ahead.
So
I mean,
what
I
I th-
haven't
I
built a
mean-
relationship with a seller in Latin America.
I think the most important part, the key lesson learned that I had from dealing with a seller is that you have to understand that the culture of the seller will be the culture of the company. So if you feel comfortable with the seller, it's highly likely that you will feel comfortable with his employees that are going to be the people that are going to be working with you. So the first question that you have to ask is, would I have a long-term relationship with this guy, even though he's going to be gone once you buy the business, probably? The people that are going to be working for him will have his culture, because culture comes from the top. So I think that's the first thing that you have to understand. And in terms of building the relationship, in our experience, and this, I think it varies in different countries, but humbleness was always the best tool. Just listen more than you talk, reference check, and just be patient, no? Because if you try to like push it too much, then it doesn't work. Irv Groswick will always say that people sell their businesses to the people that they like. And I think that's also key to have in mind. If you build a relationship and there's chemistry between you and the seller, you will probably get the deal done. If that chemistry is not there, even if the numbers work, or I don't think you should spend too much time with that business, because it will probably be broken before it's done. And if it gets done, then you will realize that the people working there will probably all need to change in order for you to feel comfortable with the business, no?
On a similar, I don't know if it truly applies, but I think some countries in Latin America are very much relationship-driven countries. So I think it's very important who you have in your investor base to help you gain, as a young entrepreneur, when you knock on that door, gain credibility when the door is open, much more than in the US. So I think in some of these countries, you do have to figure out in your investor mix, who is the local families that you're bringing into the fray. And my experience is that it varies by country. Some countries is more important than others.
Yeah.
But most, if not all of Latin America is a relationship-based country that's not going to guarantee success, but it will certainly open doors and help a lot. And that's what I think local investors are an important part of the fray.
I mean, and credibility starts with the fact that the seller believes that you actually have the money to buy the company, right? Because
Yeah.
that's one of the questions. Like you do not have the funding, you have to go source it. If you have the right names in the list, they will believe that you will, which it might not be true, but it makes it more compelling. So I think it does make a difference having those local names in your list of investors, because otherwise people start wondering if you're real with the money or not, no?
Yeah.
Good morning. Vincent Grimaldi from IEM Lyon Business School. I was wondering, you were talking about international and domestic investors, both between the US and at a regional level. And I was wondering, how did you handle geographical distances in situation of global or regional recession, when basically a large part of the portfolio is in trouble?
I think that's kind of what we mentioned, right? I mean, you're going to go to Latin America, and my personal opinion, if you're going to get concerned when there's a national recession in Brazil, that your investment is worth 40% less, you shouldn't be investing in Brazil, because it will happen more than once. So I mean, it's a different stomach you need to have to put money in these countries. If you look at it like, oh, my portfolio is ruined because The reality is a 4.3. You know, I mean, we just went through Brazil through the worst recession in recorded history, and my investors were pumping in money. I mean, they you know, Gerald included, you know, they understood it. And if I had an investor that was just concerned because a macroeconomic issue that we all understand is temporary because what we are betting on is on the long-term success of the country, you know, then I would have been doomed. But it's a different, complete mindset that you have to be successful investing in this type of illiquid businesses down in the region. I don't know, you guys have?
Yeah, I agree.
Thank you. I'm Robert Perot from Novak Partners. I guess I come from South Africa, and it's a similar kind of business environment. And I was involved with a lot of startups there, and I guess a big concern is the sources of your investors' funding and where all that has come from. Do you guys have a bit of a due diligence process around that, or a way of verifying that funding?
My experience has been that I usually know who the locals are, and if not, the searcher knows them and can give a good character reference. So I do pay attention to that. I don't have a formal process of vetting out people, but the community has not gotten to a level there that I think I mean, you never know, right? But I think it's an important question, and in the searches I'm in, and in my company, especially in my company, I pay a lot of attention to that, but in the searchers, you know, I kind of know most of the capital that comes in locally, and if not, I always ask the questions, you know, how you got to this person, and double check the answers.
Thank you.
Yeah, it's still a relatively small network of investors, so you typically know most of them. And if not, you should, you know, just cross-check for any references. If you have somebody that you think might have, you know, money from, you know, informal sources.
From informal source. But now that you brought a question about the investors, I think something that I forgot to mention is, in our case, with investors, something that we did not do enough with the local guys is to explain the model to them, because they sort of listen to it and then they're like, yeah, I'll put 35,000, 50,000 to do the search, and then I'll see what I do down the road. And we had many investors who gave us the 35,000 for the search, but then they never really understood that there was a large check coming afterwards. And I mean, it has nothing to do with the informal resources, but it has to do with the fact that local investors, sometimes they just say yes because they have a personal relationship with you, they value you, or they have a family connection or something, and they put the money for the search, but they do not really understand that there's a large check coming. And I think just a piece of advice is to educate your investors and make sure that they're actually understanding that the search money is just a ticket, and what you really want is the money down the road. Because in our case, that was a big part of the issue. Why we were missing so much money is because a lot of people did not really understand that we wanted the other check afterwards, and it was a large check, so a lot of people did not contribute. No?
Hello, Tarek Sheikh. I'm raising a search fund in East Africa. I have a question around the debt financing, or the risk that you mentioned around the lack of debt financing. There's a lot of DFIs who are focused and mandated to invest in terms of debt into, you know, emerging markets with long-term debt, 10 to 15 years. What impact has this had? Is it something that you've looked at? Has this been part of either the buyout or expansion strategy for you in terms of financing?
You mean like international?
Yeah, like the IFC
Yeah.
and these sort of institutions who are mandated, especially in healthcare, education, and
They move at a different speed that you need to move.
I would say, you know, there are two constraints behind that. The first one is they typically don't lend for acquisition financing. They lend to grow the company. and most importantly, what Jose just said. So it will take them 12 months to get a check for you. So you know, if they put a check. So it will eventually get there to finance the growth of your company, maybe, but not for the acquisition of a company.
And check size also, right? I mean, IFC, like if you're at early stage growth, IFC will not even look at you.
Exactly.
Jose, this is sort of orthogonal to that line of questioning, but just going back actually to your opening question of what's exciting about
Yes.
Latin American search, is I have a perception that the quality of Latin American searchers is incredibly high. And my hypothesis for that is that it's harder to be, there are less entrepreneurial options in front of a prospective entrepreneur in Latin America. It's harder to start a company, the market isn't as big, and so if you're sort of an equally talented, I'll just say American, you have many more paths to becoming an entrepreneur. I think that's not as true in Latin America, and so as an investor, it's great because the people that find their way to the search fund path are high quality, so that's exciting. And I think it leads to a second point, which is I also think that Latin American searchers, once they've run the company for 3 or 4 years, have a unique advantage in what is one of the hardest things, which is building a high quality team and adding high quality people to your team. And I've seen you do this at QMC and other searchers do it, where a search fund operating company is a uniquely attractive place to work for highly talented locals who've perhaps come to a school like ESA or have an international education or worked overseas, and they can come back to a local market and work for a company that feels like what they've seen elsewhere.
Yep.
And it's kind of a force multiplier for what is the biggest challenge, really, of running a search fund company, which is adding talent.
It is.
So it's sort of an exciting 1-2 punch.
I agree. I agree. I think, and always recruiting. So,
But I think talent is definitely the biggest issue that you will face. And from my perspective, it goes two ways. The second part is how do you bring these high caliber people. But the first challenge is how do you keep the people at the company that you're buying, no? And the first hiring process that you have to go through is to sit with everyone at the company that you're buying to sort of hire them in a sense to work for you, not because you're buying the company, they see you as their boss. You're young, inexperienced, know nothing about the industry, you look different, speak different, and now you are there to say that you are the CEO of the company. So you need to sort of sit with them, spend the time, build a relationship, and you have to be very clear that you have to hire them to work for you, and not just by buying the company, but by actually becoming their boss through working with them. No?
and I think it's, Gerald, I agree with both of your comments. And like for us to hire MBAs is I think we have developed a value proposition that's very interesting. There's Andrea Marcelo had a very interesting situation in Brazil, hiring a very experienced professional, where this person actually came to me and asked, but these are kids. These guys are too young. I mean, do they really manage a company? I go, yeah, I mean, believe me, I got gray hair now, but I was in those shoes back then, and I got asked the same question. So it is harder, but also much more. To your point, it's harder. I think to your point, we do get, once you get it going, you get a flow of good talent coming in that what allows you to expand the company. So it is very interesting.
It has been our experience as well, the same thing. So we've been able to recruit summer interns every summer from top business schools around the world, and one of those interns, for example, is now the CEO of our Colombian operation. So it helped us expand into a completely new geography, much faster than what we've done in it by ourselves. We didn't have the bandwidth. So by recruiting this, by having access to this very talented pool of talent, you can expand faster into new geographies, new products, new anything that would allow you to grow faster across different.
We have a similar experience in our company
Yeah.
with one of our markets. Yeah.
But the same elements that help you to bring these high caliber people down the road are a disadvantage when buying the company first, because those same reasons that make you interesting for MBAs make you sort of scary
To the existing
to the
people in the
existing
company.
employees, no? So you have to just
And I agree 100%.
have to
And I
understand
think
that.
it's a balance, versus what what Andrea Marcelo lived and what I'm living now. And I think it's stages of maturity of the company. We go through different ones. Yeah, that makes it fun.
makes it fun.
Time? Well, thank you so much.
Thank you.
Appreciate it. Great guys.